So let's just talk about investing for a second. Well, first, let's look at how much are we going to invest, right? So we're over here. We've got our invest the difference. Over here, we have our sacred account, right? So most people, when they invest the difference with term, what are they doing? They're usually buying mutual funds. Right? That means they're putting it with Wall Street. The average return, and this is not my statistic, this is from Dalbar, they're a mutual fund rating agency. The average mutual fund investor over the last 20 years makes about 3.88% after fees, but before taxes and before inflation. Right? Now, this is like the average. Let's say that you're really good and you can get 8% over the long haul annually. I'm not saying what did you get last year. I'm saying over the long haul. If you look at, 20 years of investing, I mean, let's look at the market right now. Let's look at the S&P 500 and we'll pretend like we're going to get that number. Okay, so the S&P 500 over the last 20 years did an annualized return of, this would have been since 2002, did an annualized return of 7.5%, which is pretty close to what I said, and that's with dividends not reinvested. If we reinvest dividends for the last 20 years, the annualized return was 9.57%. This is in the stock market. This is in the S&P. This literally, and this is before fees, right? So if you have fees, let's say with your average mutual fund fees, you've got annual fees, you've got 12B1 fees, you've got cash drag, you've got, also there's the account fees, quarterly fees. So the fees on a mutual fund account, generally, it cuts it about in half. So even on this 9.57, you're probably looking closer to like 4 to 5%. Because there's so many different fees and things in there. Like you only see the one fee when they pitch this to you, they're like, yeah, we just charge 1% a year. If you dig deep in the prospectus, you're going to see that there's mutual fund turnover, which is taxes. Every time the fund manager sells something, you're going to pay the taxes for the sale that they did. It wasn't up to you. You could actually get taxed in the mutual fund for investors that owned it before you ever did. Right? There's also cash drag. Like they have to keep a certain amount in cash reserves and liquidity that reduces your return. There's typically there's going to be account annual fees. There's going to be management fees. There's going to be 12B1 fees, right? So usually you're going to see about half of this, which means we're probably only netting about 4 to 5%, right? But let's pretend that none of that's true. Let's pretend that none of that's true, and we're still going to make the entirety of the stock market minus just a 1.5% annual fee. So we're making, like I said, about 8 after fees, right? So we buy term, we invest the difference, right? So we put $1 in, and let me just clean this up a little bit for you guys. We put $1 in this mutual funds, and we are going to get 8% on that $1. That's it, okay? With the sacred account, we put $1 in, we're getting 3 to 5%. So let's just deal in certainties. Let's just call this 4. So we put $1 in, we're getting 4% on that $1. We can borrow against it at a cost of 2%, which means here we're making a positive 2% spread. We can take the money we've borrowed. We can go invest this in real estate that's paying us a cap rate of maybe 12 to 14%, right? So we have $1 growing at 4%. And then again, let's get rid of the uncertainties here. Let's just call this one 13. We'll split it down the middle. right? So we have a dollar that's growing at 4%, and also at the same time, we're making 13% on that same dollar. We are paying a cost of interest of 2%, so we've got a 2% spread. 13 plus 2 is 15. All right, so I only went to Houston High School, not a college, none of this stuff, but I know for a fact 15 is more than 8. So when I ask myself, do I want to buy term life insurance and put the difference in a mutual fund where I earn 8%, which really is about 4? Or do I want to put it in the sacred account where on this dollar in total, I'm making 15%? That's a no-brainer. And it's not even about the life insurance. Like, I couldn't give a crap about the life insurance. Like, if I want life insurance, I'll go buy life insurance. I'm not going to think about it and have all these different technical arguments. I'm looking at return on investment. Okay. You show me, you know, and this is also this number here. What does this include? This includes cost of insurance. This is another one to bring up. This includes my insurance costs. This is net of all of this. Here we said what? 20, was it 21,000? Yeah, $21,000 that we paid for insurance costs that have not been factored into this return. So I still have to factor that in. That is an expense. We're comparing apples to apples. With the sacred account, we say it's 3 to 5% because really it's higher. And after insurance costs, that's what you net. So we just tell you what you net because those are going to be included costs. We've already included them here. So here we need to account for them as well. So 15% net, 8% net of mutual fund fees, but not net of your insurance costs. So I don't know, depending on how much money you put in, what that brings you down to. Maybe that brings you down to 7.9. I don't know. Maybe it brings you down to 6, but it still brings you down further than 8. Right? So this is the, a big deal, something I wanted to point out because, this is not, it's not talked about. I was a licensed financial advisor teaching this stuff. I owned term. I was putting my money in mutual funds, and never once on the exam did I learn about this. Never once on my trainings with my management team and stuff did I learn about this, right? So that's something that I had to figure out on my own. And when I figured it out, I was like, wow, the math on this actually doesn't make any sense. Okay, now we did it easy. We did it on Zoom. Before, I did it on a notepad. Okay, literally, I went page by page, number by number, and it took me 3 or 4 hours to do. And I did all the math every single year, line by line, all the way down. And I actually saw this does not make mathematical sense. If you're wondering, what does Wealth Dynamics do? How can we actually help you? Number one, if you haven't gotten a copy of my book, Blueprint to Financial Freedom, grab one now. You can get that down in the comments in the video. You can get the link for that. Finally, if you have a desire to start getting help walking through these different phases toward financial freedom, book a call with my team. Go to our website, set up a call. We're able to help out and answer questions. That's how we can help you. Thank you for watching. Like, share, subscribe. Make sure you turn notifications on, and I will talk to you guys on the next video.